Hello and welcome back. While most of the world was asleep last night, something broke. I'm talking about February 11th, 8 p.m. Eastern. The COMEX vault data finalized, and for the first time in years, we crossed a line that was never supposed to be crossed. The registered silver inventory, the actual deliverable metal sitting in those vaults, dropped below 100 million ounces. For 12 years, I've been tracking these numbers as a private commodities analyst and physical silver stacker. I've watched the contracts pile up, watched the vault levels bounce around, watched the banks play their games. But this is different. Let me be clear about something right up front. I'm not a YouTuber. I'm a trader who built this channel for one specific reason: speed. I got tired of waiting half a day for mainstream financial media to report what I could see happening in real time on the vault screens. And frankly, I got tired of watching all these AI-pumped channels spread fake news and hype about silver without understanding the actual mechanics of what's happening. So I use this AI avatar to get real information out fast to people who actually care about the truth. It is now the morning of February 12th, 2026. The data I'm about to show you was locked in just 13 hours ago. We are not looking at history. We are standing in the impact zone. And here is what makes this fascinating. The mainstream financial press is completely focused on gold holding above $5,000. They're calling the slight dip in silver to $82.56 a cooling period. They want you to believe everything is stable. They want you to believe the liquidity is there. But the real story isn't about the price on your screen. The real story is about the cupboard. The ATM of the silver world just hit its daily withdrawal limit, and there's a line of people, 5 blocks long, holding cards that say they're entitled to metal. Metal that, mathematically speaking, does not exist in the quantities promised. Think about that for a second. The paper contracts say you can get your silver. The vault inventory says maybe not. Now, I've been watching these vault reports for over a decade. I've seen drawdowns before. I've seen squeezes start and fizzle. I've seen the banks wiggle out of tight spots more times than I can count. But I have never, and I mean never, seen a ratio this extreme while the mainstream media stays this quiet. The banks are projecting calm. Their public statements are measured and confident. But their own internal inventory reports are screaming a very different story. And wait until you see what just happened in Shanghai. Because while the COMEX vaults are draining, the safety valve that usually exists, the ability to source metal from Eastern exchanges, just got welded shut. We're going to get into that in detail, but the short version is this. The escape hatch just closed. So if you're thinking you can just sit back and wait to buy the dip if this thing breaks, you haven't seen the new pricing from the Royal Mint. You haven't seen what's happening to premiums on bulk orders. And you definitely haven't run the math on what happens when 528 million ounces of paper claims try to settle against 98 million ounces of physical metal. That's where we're going in this broadcast. Here's my primary claim, and I need you to understand this clearly because everything else flows from this point. The silver market has entered a state of mathematical impossibility. As of last night, the March contract open interest on the COMEX stands at 528 million ounces. That's the total amount of silver that contract holders have the right to demand for delivery. The registered inventory, the only silver that is actually cleared, warranted, and ready to be delivered to those contract holders, sits at 98.1 million ounces. Do the division. That's 5.38 claims for every single ounce of deliverable metal. Let me say that again in plain English. For every ounce of silver sitting in the deliverable category, there are more than 5 pieces of paper saying someone owns that same ounce. This is not a normal market condition. This is not a tight squeeze that can be resolved by rolling contracts forward or raising margin requirements. This is a structural failure of the entire paper-to-physical bridge that the commodities market is built on. Now, I know what some of you are thinking. You've heard about squeezes before. You remember 2021 when Reddit got excited about silver? You've seen the predictions that never panned out, and you're wondering if this is just more noise. So here is my promise to you for this broadcast. I'm going to break down the exact mechanism of how registered versus eligible inventory works. I'm going to walk you through the stress test math that the COMEX does not want retail investors to see. I'm going to show you the real-world pricing data that proves the paper market and the physical market have already started to decouple. And then I'm going to share my personal force majeure battle plan, what I'm doing with my own positions if this goes where I think it's going. I'm not here to hype you. I'm here to show you the numbers and let you draw your own conclusions. But I will tell you this. If you think the solution is to just wait and see and buy physical silver after the price spikes, you're already too late to get it at anything close to spot price. The premiums are already detaching from reality. I was looking at Royal Mint pricing a few hours ago, and what I saw should terrify anyone who understands how wholesale precious metals work. We're going to get into the specifics, but the summary is this. The people who sell silver in bulk are now charging more for bulk orders than small orders. Read that again. Normally, buying 500 ounces saves you money compared to buying 10 ounces at a time. Today, buying 500 ounces costs you a 16% premium penalty. Why? Because they don't have the inventory to fill large orders. The wholesale supply chain is already broken, so that's the promise. By the end of this broadcast, you're going to understand exactly what's happening, why it matters, and what the potential outcomes are. And then you can decide what to do with your own money. Let's start with the foundation, the teaching block. If you're going to understand why this situation is so critical, you need to understand the difference between registered and eligible inventory. This is the mechanism that everything else is built on, and most people, including most financial journalists, don't actually understand how it works. So let's pull this apart. When silver sits in a COMEX vault, it falls into one of two categories, eligible or registered. Eligible silver is metal that meets the exchange's quality requirements and is physically sitting in an approved vault. But here's the key. Eligible silver belongs to someone else, and it is not for sale. It's not cleared for delivery against futures contracts. It's just there. Someone owns it. They're storing it in a COMEX vault, but it's off the table as far as the exchange is concerned. Think of it like this. You go to a parking garage and you see 100 cars parked there. Those cars are eligible to be driven. They're real cars. They work. They're in the garage. But you can't just hop in one and drive away because they belong to other people. They're not available to you. Registered silver, on the other hand, is the metal that has been specifically warranted and cleared for delivery. It's the silver that contract holders can actually claim. It's the inventory for sale. So when you hear that there are 528 million ounces of open interest on the March contract, what that means is 528 million ounces worth of contracts that could, theoretically, demand physical delivery. And when you hear that registered inventory is at 98.1 million ounces, what that means is that's all the silver the exchange has actually set aside and cleared to fulfill those deliveries. Here's the analogy I want you to hold in your mind. Imagine a game of musical chairs. There are 538 people walking in a circle around the room. Now look at the center of the room. There are 98 chairs. As long as the music keeps playing, as long as people keep rolling their paper contracts forward instead of demanding delivery, everything is fine. Everyone can keep walking. The system works. But the moment the music stops, the moment people try to sit down and claim their physical metal, 440 people are going to hit the floor. And unlike musical chairs, this isn't a game. This is people's money. This is institutional positions. This is pension funds and sovereign wealth funds and private investors who were told their contracts were backed by real metal. Now, why does this matter right now, specifically? Because we have officially dropped below 100 million ounces of registered silver. That's the cash in the drawer. That's the deliverable inventory. And we haven't been this low in a very, very long time. If the March contract holders decide they want their metal, if even a fraction of them stand for delivery instead of rolling forward, the COMEX doesn't just have a problem. It has a default. Let me give you some historical context. Back in 2021, during the Wall Street Bets silver squeeze attempt, the registered inventory was sitting around 120 million ounces, and the open interest was around 180 million ounces. That was a ratio of about 1.5 to 1. People got nervous, the banks raised margins, the squeeze fizzled. Today we're at a ratio of 5.38 to 1. This is 3 times more severe than the situation that had everyone panicking 3 years ago, and almost nobody is talking about it. So why isn't the COMEX just bringing in more silver from the eligible category? Why can't they just convert eligible to registered and solve the problem? Because the owners of that eligible silver have to agree to warrant it. They have to agree to make it available for delivery. And here's the thing. If you're sitting on a big stack of physical silver and you're watching the registered inventory drain and you're seeing premiums spike in the physical market, why would you make your metal available to the exchange at $82 an ounce? You wouldn't. You'd hold it. You'd wait for the price to go higher, or you'd sell it privately at a premium. And that's exactly what's happening. The doors are locking, the vault is draining, and the people who have the keys to the eligible silver are not opening them. But surely, you might be thinking, the banks can just source more metal from other markets, right? They can import it from London or Shanghai and refill the vaults, right? Wrong. The door is just locked in the East. And that's the next piece of this puzzle. Let me show you what's happening in the real world outside of the paper contracts and the vault reports. As of 8 p.m. Eastern on February 11th, silver was bid at $82.56 per ounce. Gold is holding steady at $5,053.05. On the surface, those prices look calm. Silver is down a fraction of a percent from its recent highs. Nothing alarming if you're just watching the ticker. But here is what happened in the vaults over the last 24 hours. 3.25 million ounces vanished from the registered category. That's not a gradual drain. That's not a slow bleed. That is a massive institutional withdrawal happening in real time. Now, where did that silver go? Some of it probably got delivered against expiring contracts. Some of it might have moved to eligible status, meaning the owners decided to take it off the delivery table. But the bottom line is this: the inventory available for delivery just took a massive hit in a single day. And that brings me to the smoking gun that most people are missing: the bulk penalty. I was looking at Royal Mint pricing a few hours ago, and what I saw should not be possible in a normal market. The Royal Mint is now charging a 16% premium for monster boxes, 500-ounce bulk orders, compared to smaller tubes of 25 ounces. Read that again. Buying in bulk is more expensive than buying small. In every other commodity market on the planet, bulk orders get you a discount. You buy wholesale, you pay less per unit. That's how supply chains work. That's how economies of scale work. But today, if you want to buy 500 ounces of silver from the Royal Mint, you're paying a penalty. You're paying more per ounce than the person buying a single tube. Why? Because they don't have the stock. They don't have the inventory to fill large orders. So they're rationing it by making bulk purchases prohibitively expensive. This is not a pricing strategy. This is a shortage response. And it's not just the Royal Mint. I'm seeing similar patterns from other major dealers. Premiums on bulk orders are spiking. Delivery times are stretching. The wholesale supply chain is showing stress fractures. Now let me show you what just happened in the East. The Shanghai Futures Exchange, SHFE, just announced that starting at the end of this month, they are banning non-commercial silver delivery. That means if you're not a registered commercial entity in China, you can't take delivery of physical silver from the Shanghai Exchange. Why does this matter? Because for years, one of the safety valves in the global silver market was the ability to arbitrage between exchanges. If the COMEX was getting tight, the banks could source metal from Shanghai, ship it west, and refill the vaults. If London was short, they could pull from New York. The system had pressure release valves. That valve just got welded shut. China is effectively saying, our silver stays in China. You want metal? Find it somewhere else. And this is happening at the exact moment that the COMEX vaults are draining below 100 million ounces. So now let's talk about what the price is actually doing versus what the price should be doing. The paper price on the COMEX is $82.56. That's what your screen says. That's what the futures contracts are trading at. But if you want to actually buy 500 ounces of physical silver today, if you want to take possession of real metal, you're paying close to $95 per ounce after premiums. That's a 15% spread between paper and physical. The two markets have already started to decouple. The paper price is becoming a work of fiction. The real price, the price you have to pay to get your hands on actual metal, is already in a different universe. And this is before the squeeze even really starts. This is before the March contracts come due and people have to make the decision. Do I roll forward or do I demand delivery? This is before the vault hits 90 million ounces or 80 million or whatever number finally triggers the panic. We are in the early innings of this thing, and the real world pricing is already screaming that something is very, very wrong. The argument. Now, I know there are people watching this who think I'm being alarmist. I know there are skeptics who have heard squeeze predictions before and watched them fizzle. So let's address the strongest counter-arguments directly, because I want you to see both sides of this. Skeptic argument number one: the shorts will just roll. This is the most common pushback I hear. The argument goes like this: most of that 528 million ounces in open interest will just roll forward to the May or July contracts. That's what always happens. People don't actually stand for delivery. They just keep pushing their positions into the future. The system works because everyone agrees to keep the music playing. And historically, that's been true. Most contract holders do roll. Most of the time, the paper game continues. But here is the rebuttal. Rolling a contract requires a counterparty. You need someone on the other side willing to sell you that next contract at a reasonable price. And if the buyers on those March contracts look at the vault data and see that registered inventory has dropped below 100 million ounces, if they see that the ratio of claims to metal is 5-1, they have every incentive not to roll. They have every incentive to demand the physical metal and force a squeeze. Because once you demand delivery and get your metal out of the vault, you own it. It's yours. And if the vault keeps draining after you take your metal, the price of what you're holding is going to go parabolic. So the assumption that everyone will just roll like they always do breaks down when the incentives change. And right now, the incentives are changing fast. Skeptic argument number two: JP Morgan will save the market with their hoard. There's a persistent rumor in the silver community that JP Morgan has been quietly accumulating a massive stockpile of physical silver over the past decade. Hundreds of millions of ounces sitting in vaults, ready to be deployed if the market gets tight. And the argument goes, if things get really bad, JPM will just open the vault, warrant their silver as registered inventory, and flood the market with supply. Crisis averted. Here's the problem with that theory. The latest rumors I'm hearing suggest that JP Morgan is refusing to warrant their metal. Think about what that means. If JPM has a giant pile of silver and they're choosing not to make it available to the exchange, that tells you something very important. They don't want to sell it at current prices. They're not holding that silver to save the market. They're holding it because they think it's going to be worth a lot more in the future. Now, I can't confirm those rumors. I don't have access to JPM's internal strategy. But I can tell you this. If the biggest player in the silver market is hoarding metal instead of warranting it, that is not a bullish sign for the COMEX's ability to fulfill deliveries. Skeptic argument. Number 3, the COMEX will just raise margins and shake out the small players. This one is actually true. The COMEX absolutely has the power to raise margin requirements on silver contracts, making it more expensive to hold a position. And when they do that, the small retail traders get squeezed out. They can't afford the higher margins, so they close their positions and the open interest drops. This is a real tool the exchange has, and they've used it before. But here's the thing. Raising margins doesn't create more physical silver. It just reduces the number of claims on the existing silver. If the vault is at 98 million ounces and the open interest is 528 million, raising margins might drop the open interest to 400 million or 300 million. But you're still sitting on a ratio of 3 to 1 or 4 to 1. You're still underwater. And here is the bigger problem. If the COMEX starts aggressively hiking margins in an obvious attempt to kill the squeeze, that sends a signal to the market that they're scared, that they don't have the metal. And that signal could trigger the exact run on the bank that they're trying to avoid. So yes, they can raise margins. But it's not a magic bullet. It's a band-aid on a structural problem. And even if they do shake out the small players, the big institutional holders, the ones with deep pockets and long-term strategies, those guys aren't getting scared by a margin hike. They're going to stand for delivery. Now let's talk about the math. All right, let me recap where we are because this is the 60% mark of this broadcast, and I want to make sure we're all on the same page. Here is what we know for certain. The registered vault inventory is at 98.1 million ounces. The March contract, open interest, is at 528 million ounces. The Royal Mint is out of bulk stock and charging penalty premiums for large orders. China has closed its delivery window to non-commercial buyers. Those are facts. Those are not predictions or theories. Those are the numbers as of last night. Now let's run the scenarios. I'm going to walk you through 2 different models. A conservative scenario where most people behave the way they normally do, and a stress test scenario where fear starts to spread and people make different decisions. Conservative scenario, the optimistic case. Let's assume that 80% of the contract holders roll their positions forward to May or July, just like they usually do. That's a high estimate, but let's be generous. That means 20% of the open interest, 20% of 528 million ounces, stands for delivery. 20% of 528 million is 105.6 million ounces. The registered inventory is 98.1 million ounces. Do you see the problem? Even in the conservative scenario, even if 80% of contract holders do the normal thing and roll their positions, the remaining 20% demanding delivery would require more metal than the vault has. The system fails even under normal conditions. Now you might say, well, they'll just convert some eligible to registered and cover the gap. That's only a 7 million ounce shortfall. They can cover that. And maybe they can. Maybe they convince enough eligible holders to warrant their metal and make it available. Maybe they source a few million ounces from London or from private vaults. But here's what that tells you. We are now in a situation where the system is relying on last-minute conversions and emergency sourcing just to handle a normal rollover scenario. There is no buffer. There is no safety margin. We are one bad day away from default. Stress test scenario. The fear case. Now let's run the stress test. Let's assume that the news about the SHFE shutdown spreads. Let's assume that contract holders start doing the math and realize that the ratio of claims to metal is 5 to 1. Let's assume that instead of 80% rolling, only 60% roll. That means 40% stand for delivery. 40% of 528 million ounces is 211.2 million ounces. The vault has 98.1 million. The COMEX would need 215% of everything they have in registered inventory just to cover the deliveries. And where are they going to get the other 113 million ounces? They're not. It doesn't exist. Not at these prices. Not in deliverable form. This is the ghost gap. This is the phantom inventory that the paper contracts assume exists, but physically does not. Now, I've been staring at vault charts for over a decade, and I want to show you something. If you were to graph the registered inventory levels over the past 5 years, you'd see a fairly stable line bouncing between 150 million and 200 million ounces most of that time. But starting in late 2025, that line starts to curve downward. And in the past 3 months, it's not just curving, it's falling off a cliff. We went from 120 million ounces in mid-November to 98 million ounces today. That's 22 million ounces gone in 3 months. And the rate of decline is accelerating. If we lose another 5 million ounces by February 20th, if the vault drops to 93 million, we're looking at a full-scale run on the bank. Because at that point, even the conservative scenario doesn't work. Even if 85% of contracts roll, the math breaks. And once the math breaks, the rules change. What happens next? So let's talk about what the COMEX and the banks are going to do when they realize they can't fulfill deliveries with physical metal. Here is what I expect to see over the next few weeks. First, margin hikes. The COMEX is going to raise the cost of holding a futures contract. They're going to make it more expensive to stay in the game. This is their first line of defense. They'll frame it as prudent risk management or maintaining market stability. But the real goal is to force retail traders out of their positions and reduce the open interest. Watch for the announcement. It'll probably come late on a Friday afternoon, and it'll be buried in technical language, but the effect will be immediate. Small traders will get squeezed, positions will close, open interest will drop. But like I said earlier, this doesn't solve the underlying problem. It just reduces the number of claims on insufficient inventory. Second, media blackout. Have you noticed how quiet the financial press has been about the 100 million ounce breach? Have you seen any headlines about the vault drain? Any articles explaining the 5-to-1 ratio to the general public? You haven't, and you won't. Expect technical glitches in reporting if the vault drops another 5 million ounces. Expect delayed data releases. Expect carefully worded statements from exchange officials that sound reassuring but don't actually say anything concrete. The last thing the COMEX wants is a panic, so they're going to manage the information flow very carefully. Third, watch the dashboard. If you're serious about tracking this situation, there are 2 numbers you need to monitor every single day. Number 1, inventory velocity. How fast is the registered silver draining? If we lose another 5 million ounces by February 20th, we are in crisis territory. That would put us at 93 million with the March contract still open. At that point, even optimistic scenarios fail. Number 2, lease rates. This is the cost to borrow silver. When banks start cannibalizing each other for metal, lease rates spike. If silver lease rates cross 8%, that's a signal that the banks are fighting over scraps. It means the wholesale market is fracturing. Right now, lease rates are elevated but not catastrophic. But I'm watching them every day. If they spike, that's your early warning signal. And here's the thing that most retail investors have never read and don't know about. Rule 5.02. Rule 5. 02 gives the COMEX the authority to settle contracts in cash instead of physical delivery in the event of a force majeure, an unforeseeable circumstance that prevents normal operations. Now, what constitutes a force majeure? That's deliberately vague. It could be a natural disaster. It could be a supply chain disruption. It could be, theoretically, an inability to source enough physical metal to fulfill contracts. If the COMEX invokes Rule 502, they can hand you a check for $82 per ounce and say, sorry, we don't have the metal. Here's cash instead. Contract fulfilled. And legally, they're covered. You signed a contract that included that clause. You agreed to the terms. Now, do I think they'll actually invoke Rule 502? I think they're preparing the legal and procedural groundwork to have that option available if things get bad enough. I think it's on the table as a last resort. But here's the problem with cash settlement. It destroys the credibility of the entire futures market. If the COMEX admits that it can't deliver physical metal, who is going to trust their contracts in the future? Why would anyone buy a futures contract if they know the exchange might just hand them cash instead of the commodity? A cash settlement event would be a catastrophic loss of confidence in the paper silver market, and that loss of confidence would send physical premiums parabolic, because everyone would realize that the only way to actually own silver is to hold the physical metal. And that brings me to my personal opinion and plan. Let me be very clear about something. What I'm about to share is my personal opinion based on 12 years of watching this market. This is not advice. This is not a recommendation. This is what I think is happening and what I'm doing with my own money. I believe we are witnessing the grand decoupling. I believe the paper price of silver, the number you see on your screen, the $82.56, is becoming a work of fiction. It's a price that exists in the abstract world of futures contracts and leverage and margin accounts. But in the real world, the world where you actually want to take possession of physical metal, that price doesn't exist anymore. Try to buy 500 ounces right now. Try to find a dealer who will sell you a monster box at $82 per ounce with no premium. You can't. It doesn't exist. The real price, the price where metal actually changes hands, is already somewhere between $90 and $95 per ounce. And that spread is widening every day. So here's my take on what's coming. I think the COMEX is preparing to settle contracts in cash rather than metal. I think they're going to invoke some version of Rule 502, hand out checks for $82 per ounce, and hope that the legal fallout is manageable. And when that happens, the physical market is going to go absolutely insane. Because if the COMEX can't deliver, and the paper price is revealed to be meaningless, then the only price that matters is the price you can actually buy physical metal at. And that price is going to be set by supply and demand in the real world, not by leverage ratios on a screen. I think we're going to see physical premiums go from 15% to 30% to 50% over spot. I think we're going to see delivery delays stretch from weeks to months. I think we're going to see major dealers simply stop taking orders for bulk quantities because they don't have the inventory. And here's the thing that keeps me up at night. Once the vault is empty, the price becomes irrelevant. Ownership is everything. You can have all the money in the world, but if there's no silver available to buy, your money is worthless in that context. You're holding cash and watching the metal you wanted to buy disappear into private hands at prices you'll never see again. So what am I doing? If silver holds above $82.50 through this weekend, I'm maintaining my core physical position. I'm not selling, I'm not trading, I'm holding. I'm not touching paper leverage right now. The volatility is too high and the counterparty risk is too real. If the COMEX does invoke cash settlement, everyone holding paper contracts is going to get railroaded. They're going to get paid out at the paper price, while the physical metal trades at a 50% premium in the gray market. I don't want to be anywhere near that when it happens. Now, if we do see a cash settlement event, if the COMEX blinks and admits they can't deliver, I am personally looking for off-exchange physical opportunities. I'm talking about private sales, coin shows, local dealers who might have inventory they're holding back. And yes, I expect to pay high premiums in that scenario. I expect to pay 20, 30, maybe 40% over whatever the paper spot price is at that moment. But here is my logic. If the COMEX defaults, the paper price becomes meaningless. The only thing that matters is, do you own the metal or not? And if you don't own it yet, you're going to pay whatever it takes to get it because the window is closing. I've been in this market long enough to know that opportunities don't wait. By the time the mainstream press is writing headlines about the silver shortage, by the time your uncle, who doesn't follow markets, is asking you about buying silver, it's already too late. The premiums are already at 50%. The dealers are already sold out. The time to act is when the data is screaming but the world is still asleep. And right now, the data is screaming. Registered inventory below 100 million ounces for the first time in years. 5 claims for every ounce of deliverable metal. China shutting down deliveries. Premiums spiking on bulk orders. The physical and paper markets decoupling in real time. This is not normal. This is not a temporary squeeze that's going to fizzle out. This is a structural failure that's been building for years, and we're now watching it play out in slow motion. So I'm not waiting for the official announcement. I'm not waiting for the COMEX to admit they have a problem. By the time they do, the premiums will be at 50% and the inventory will be gone. I'm acting on the data I can see right now, and if I'm wrong, if this whole thing resolves peacefully and the vault gets refilled and the contracts roll smoothly and everything goes back to normal, then I'm sitting on a pile of physical silver that I bought at $80 to $90 per ounce. And I'll sleep just fine at night knowing I own real metal instead of paper promises. But if I'm right, the people who waited are going to be chasing metal at $120 per ounce with 3-month delivery delays, wondering why they didn't act when the signals were obvious. That's my take. That's my plan. You have to make your own decision based on your own situation and risk tolerance, but don't lie to yourself about what the data is showing. Recap. All right, let's bring this home. Here's what we know. The COMEX registered silver inventory has breached the 100 million ounce floor. We are now sitting at 98.1 million ounces of deliverable metal backing 528 million ounces of paper claims. That's a ratio of 5.38 to 1. The exits are closing. China has shut down non-commercial deliveries from the Shanghai Exchange. The Royal Mint is charging penalty premiums on bulk orders. The physical and paper markets are decoupling in real time, with physical metal trading at 15% or more above spot. And the mainstream financial media is silent. This is not a drill. This is not hype. This is math. You have 538 people in a room with 98 chairs, and the music is getting quieter by the day. For years, we've talked about the manipulation in the silver market. We've talked about the paper games the banks play, the leverage they use to suppress prices, the disconnect between physical supply and paper claims, and now finally, the math has caught up. The system that was built on the assumption that most people would never demand physical delivery, that assumption is breaking down. And when it fully breaks, the price discovery mechanism is going to shift from the futures exchanges to the real world. The price is going to be set by whoever has metal and whoever wants to buy it, not by margin clerks and leverage ratios. So here is my rallying cry. Don't let the paper price distract you from the physical reality. The number on your screen is not the number you'll pay when you try to buy real metal. The futures contract is not a guarantee of delivery if the vault is empty. The only thing that matters in the end is, do you own the metal or do you own a promise? And if you own a promise, you better hope the person who made that promise can actually keep it. Now, if you want to understand exactly how the banks manipulate the lease rates I mentioned earlier in this broadcast, the mechanism they use to hide the true cost of borrowing metal, you need to watch my previous breakdown on central bank gold swaps. That video goes deep into the accounting tricks and the off-balance sheet maneuvers that let central banks and bullion banks pretend they have more metal than they actually do. It's the missing piece of this puzzle, because the silver squeeze isn't happening in isolation. It's part of a much larger breakdown in the precious metals manipulation structure that's been in place for decades. Watch that video, understand the full picture, and then make your own decision about what to do. Because this is the moment we've been talking about for years. The math has finally caught up to the manipulation. The vault is draining. The claims are piling up. And the people who act on the data, instead of waiting for permission from the mainstream media, are going to be the ones who own the metal when the smoke clears. That's all I've got for you this morning. Stay sharp, watch the inventory, watch the lease rates, and make your own plan. I'll see you in the next one.